Welcome to the Real Vision Daily Briefing. It's Thursday, January 6, 2022. I'm Ash Bennington here with Tommy Thornton, founder of hedge fund telemetry. Thomas, welcome back. It's great to have you on the show again.
Welcome back to you too. It's been a while for you since you've been on the daily briefing, and I'm happy to have you today. Maggie's been great, but we got to catch up. We got a lot to talk about.
Absolutely. I know it's been a minute since we've done the show together. Let's zoom the camera out, Tommy, and talk about what's happening big picture right now. Equities down, yields up. Obviously, crypto also taking a hit. All eyes on the Fed, inflation, talk of taper, rising rates, a balance sheet unwind. What's going on here, Tommy? I know you've been very busy. You've been active on Twitter. How are you thinking about this, and how are you positioning yourself?
Okay, so I thought today about the equity market, and I looked at all the internals, and I looked at a lot of the different facets of what's been happening. And we've seen a market over the last quarter with a lot of stocks that have already been hit and pushed down pretty hard. And finally, in the last few weeks, or actually last week, we've started to see the mega cap stocks start to give way. And I would say that the catalyst has been what the Fed said. They're hawkish, which I don't think anybody should be that surprised. But the bond market has sold off, and it spooked all the high-flying tech stocks and generally a lot of the market, except for the value stocks. And there's been a huge rotation into value, which is financials, energy, materials, some industrials, cyclicals. So I think there's a lot going on. And where do you want me to start?
Gosh, there's a lot to unpack there. Let's start with the bond market, as that sounds like the catalyst in terms of your framework. How are you looking at it? What rates are you looking at? What time horizons, and how are you thinking about it?
Well, there's a lot in the bond market that I'm watching, and I thought we were going to see a bit more of a flattener between the 210. Thought we have a little bit more. It reversed, and it actually today, it flattened a little bit today. But I think that the 10-year, which is my focus, breaking above 1.7%, was really a important level, because that's the recent peak. And I look at waves, and that was the third wave higher, and now we're in the fifth wave, and I have a price objective of just under 2% for the 10-year. What's really giving me more, let's say, conviction is that we have DeMark upside signals, the countdowns on the upside on the daily, weekly, and monthly, all happening together. And when I get that type of in sync behavior with one asset in different time frames, it makes me feel like, okay, this is going to be a really powerful move. And another thing is I look at the SPY versus the TLT, which is sort of a basic ratio that I'm looking at. On a monthly, that's on month.
Let's
9
unpack
of
that,
13.
Tommy. This is S&P 500 versus TLT. This is 20-year or longer Treasury, moves relative in direct proportion to price, not yield. So when you see TLT falling, that means yields are rising.
Correct. I'm also looking at the investment grade ETFs and high yield, and both of those they've been falling as well, and those have been rock solid, and we're starting to see stress there. This is a big month for issuance, and it's going to be a big test to see if people have the appetite to digest some of the issuance that's coming. And I think there's going to be a big issuance happening in the Treasury market, because now that the debt ceiling fiasco, or I used to call it the Kabuki theater, is over. I think there's going to be a big amount of issuance coming. And then again, you have the Fed, who's tapering, and they've been the biggest buyer of treasuries. So I think that there's going to be upward stress on yields, and that will hurt equities. What happens, though, is you'll get these spikes higher, and then all of a sudden the equity market will say, "Oh, okay, we'll be cool with that," and they bounce the tech names and get a little squeeze, and then the yields go a little higher, and then they get a little bit more nervous. But like one thing that I look at, and I've talked to you about this, is I make custom indices of different stocks, and I have the MAGA index, and that is Microsoft, Apple, Google, and Amazon. I know it's a bad reference on a day like today, but the point is,
Maybe we
those
call it
main
Gamma
stocks.
Index.
Yeah, I think I built one of the Gamma index, but
So,
the thing is also on the top three NDX names, they're hitting 2.5 month lows in that index together. Now, I think it's a lot has to do with Amazon that's been really looking weak, and I wouldn't be shocked to see Amazon break under 3,000. Apple and Microsoft are a bit extended, overvalued, overloved, crowded, but we'll see how that goes. They've got huge buybacks, and the guy that's buying back the stock for Apple's just got his elbow on the buy button all day. So, look, I think that there's risk. There's a weird action in the equity markets because usually I see things that get oversold, and they're not oversold. And some of those are the percentage of stocks above the 50-day moving average within the S&P and the 20-day moving average. Those aren't oversold, and they actually spiked up on the Santa Claus 3-day rally in December. So I'm a little bit confused on the equity market. It's not necessarily a good confusion. I think there's risk that all those mega cap names could catch down to the, all the other ones, the software names, the other ones that have just been decimated. But I also like financials. I like energy. I'm not in energy. I missed this move, and I'm a buyer on dips. But I like all the big banks. I like Goldman, JP Morgan, PNC, Citi. Citi's my largest bank holding right now. So there's opportunity out here.
Tell
I
me,
just
why do you
feel
like
like
the
it's
banks?
tough.
Let me ask, if I can, why do you like the banks? Is this a rising net interest margin play on rising rates, or do you see some other secular reason why you see a tailwind there?
I think there's just the rising rates will help them if we can see the yield curve steepen. I think that would certainly help. I think there's a lot. Those are very under-owned currently, and I think that they could continue higher. I think they're safe in this type of play. I mean, somebody's going to write in and say, "Oh yeah, safe," but I think right now there's some pent-up demand for the value area, and I'm more than happy to buy the U.S. banks, which I think are in a lot better shape than European banks, Asian banks. And so I think it's more like a safe haven. It's not, necessarily going to spike up 20%, but I think that going into earnings, I think they're going to do okay.
Yeah. Tell me a lot there, but let me just draw a line under something that you were mentioning earlier, just to put a really fine point on it, particularly for people who are new to the fixed income space. We talked a lot abstractly about some of the things that were happening in the bond market, but the simplest thing to think about right now, if you're relatively new to this, is just to look at the U.S. 10-year Treasury note yield from December 31, trading on a yield basis at around 1.5, 1.49. I think it went over 1.5 today, and now here we are, 1.725. So it's 22 bips here from the end of the year. This is a really dramatic move. 10-year note yield doesn't generally move this quickly unless there's a significant driver behind it.
Yeah, and it's better economic data, which I believe we'll see for the next few months, and then it's going to start to moderate. But the Fed they've, look, Jared Dillian said the best. He said, if Kashkari is getting hawkish, imagine what all the other members, how they're reacting to the inflation data. And I think inflation will probably moderate into come April on some things, but I think that there's real risk that the Fed's they're going to finish QE tapering the end of March. And I'm not necessarily sure they're going to raise rates because I think the equity markets are going to freak out so much that they're going to say, oh, we're going to we're going to hold off. And I think that's the wrong thing to do for the Fed, specifically because they're reacting to the way the market is not necessarily the economic data out there.
Yeah, by the way, Jared's joke there, Neil Kashkari, who is the president of the Minneapolis Fed, has been consistently dovish. And so when you hear him making these remarks that sound rather hawkish, it's certainly a sign that the hardest, it's like getting a 10 from the Russian judge, I guess, right? It's just like this idea that the people who have been most resistant to the idea have come on board and said, hey, let's retire transitory, as Chairman Powell said.
I mean, maybe that's like a sentiment sign that saying that the inflation's peaked. I mean, it could be on some things, I think, but I just think that I like when Ash, you have to explain the joke that I just made. That's good.
And I love when you cap the joke with a contrarian indicator. Maybe this is an inflation peak.
Yeah, I mean, it's sometimes when you see these types of people that have had, one way opinion and they make a big 180, sometimes it's a little late. And so that's certainly a possibility.
Hey, one other thing I wanted to talk about sort of on this general theme is your ARC short. You're up 40% on this trade.
Yeah, it's look, I nothing against Kathy Wood. I think she's a great promoter and she's done really, really well. But I also look at it as a liquidity aspect and inflows, and it's actually kind of maybe something people should think about in the overall market, because in 2020, her inflows just went nuts, and I mean she had so much capital and she could just buy any stock she wanted that was speculative, that had no earnings and was the future, according to her. And she bought tons of Tesla. And look, I think that the problem is that if you start to lose that momentum, which she did last year, she's going to have to start selling down some of the high flyers and, let's just say, very illiquid stocks. And that is a risk to the fund. And I mean, if I was running a hedge fund today and I had to post all of my trades every day, I would be panic stricken that people were going to pick me off. And it's not that I'm picking her off. I actually shorted it because I thought Tesla was going to be the one that would knock her, pop the bubble there.
Right.
But we've seen huge outflows in ARC all last year, and it's weird. I have this chart that's like all green inflows and then all red outflows, and she's had to sell down a lot of her stocks, partly because just the liquidations, and that happens. I've actually, way back when, I worked at a fund that was a long only fund, and that was around 2000, and I kind of get what she went through. But the thing is, she's, the Tesla trade has actually been amazing for her. And I've said, all of her research and robo-taxis and, full self-driving and all the things that she predicted that would be happening now, and the semi truck and the roadster, none of that happened. So it was just a gamma squeeze. So I kind of look at it like it was like her hitting a hole in one, but she shanked the ball off of a tree and off of a cart path, and it landed in the hole. So it's a hole in one. She, can say I crushed it in Tesla, but everything else is falling apart right now there. And I'm not sure if I'm going to hold on to my short much longer. I might take some off. It's getting a little overdone.
Yeah. I mean, obviously, Kathy is not here with us today. If she were, I imagine she'd probably say something on the order of, hey, look, these are longer term positions. We're taking these because we're looking at the future. We're looking to growth. We're trying to predict what this world is going to look like in 1, 5, 10 years. Obviously, gamma squeezes happen. Prices move up. Prices move down. Inflows and outflows into the fund happen, but it hasn't affected the thesis.
Yeah, well, that's great. But liquidity is another issue that, if you're investors are pulling their money, your long-term thesis still isn't intact, but you're losing. People are jumping off the ark, so to speak, because they don't want to sit around for 5 years and hope these things come true. And they may, but it just may be a lot lower before a lot higher. I mean, and a lot of those stocks they don't have earnings, which let's just stop right there.
So shifting gears here a little bit, talking about things that have gone down a bit and may go up more in the future. Let's talk a little bit about crypto. Right now, Bitcoin trading at 43,257. Ethereum at 3,428 as we speak. I just saw Mike Novogratz calling a floor on Bitcoin at 38,000. I know you've been doing some DeMark analysis. What are your thoughts right now on Bitcoin, on Ethereum, and on the crypto complex more broadly?
Well, going back to the recent peak, we had a DeMark sequential exhaustion signal the day before the last high. And we recently had some DeMark buy signals. And I went out to my clients and I said, you can buy a little here. And it was around 4,500, 4,600. And I said, use a little over 4,300 as a stop. And it's just technical. It's not anything. But one thing I said is not all the boxes were checked here that gave me the confidence to say this is a super strong buy. Part of it was that there was a chance that the sequential could recycle and that continue the trend lower. And that's on the daily. And on the weekly, we've had a downside countdown in play for a while. And again, I like to see the weekly exhaust on the downside and the daily together, and that would give me a really big buy signal. So I didn't like seeing Ethereum, making a 2-month low or almost a 3-month low. And I think that when you have the NASDAQ and a lot of the high-flying stocks start to get hammered and the markets are going down hard, people own, a lot of the speculative stuff in the NASDAQ, and they're going to own Bitcoin, and they're going to sell anything that's not nailed down.
Yeah. So talking about tech, talking about the future, I want to take a look at a clip, something that I really enjoyed. This is a conversation hosted by Dr. Pippa Malmgren, and the guests are Alexander and Hector Fernandez, the Fernandez brothers. Really fascinating, insightful clip. Let's take a look.
Like if you go back to 1990 and you think about how computing was back then, very few PCs in people's homes, but there's a lot of mainframe computing, right? Yeah. We're using mainframes to process things. Think about what right now AWS is. Think about basically cloud computing. These investments were made in the 90s that are now coming to fruition today. So the pattern repeats. And that's what gaming teaches you. Find the pattern. Get ready for the cycle. That's what finance teaches you as well.
Totally.
So these worlds come together in such an incredible way that you're just waiting for that moment. You just, unfortunately, when you're 20, you don't realize how far those damn moments are. They're like 20, it's a 20-year cycle, right? You don't know what that is. But I think this is something that it's extremely important, especially for people that are watching, especially people who are like, I don't, video games, it is the toy. I don't get why this is happening. But you take a step back, you look at it. It's a way to connect with people, right?
Well, there you have it. Talk about the future of gaming, not just for gaming's sake, but the broader applications of gaming technology, gaming as a new operating system to connect the world, to connect people. I find this just absolutely fascinating, Tommy. Any thoughts on this? Have you thought about this gaming space? I think it's just absolutely intriguing. When I was out in Las Vegas during the takeover event that Real Vision did, Real Vision Crypto, I had the chance to have dinner with Alexander Fernandez, and he just blew me away with his thoughts. It's like one of those things. I've been thinking about gaming for some time. If you have friends who have teenage sons, especially, they sit in front of the computer and they play these games and they're just super engaged in it. And sitting down with Alexander, I had this sense of like the ideas that I'd thought about in the shower just come back to me elegantly formed in Alexander's analysis of the world. Just a really impressive guy with a really interesting take on this space.
The gaming world is well, it's exploded. I mean,
Yeah.
already the Oculus goggles and the AR goggles that Apple's going to have, and they're going to. I mean, I heard of a friend of mine said that he got it for his son for Christmas, and he tried it, and it's really cool and great. I think the bigger application is going to be maybe military, and people don't realize that these people are going to have these goggles, and they're going to be piloting a drone, flying around the world, and hopefully not killing people. But the bottom line is, they make video games so close to real life. There's some frightening thoughts there. On a better note, I do have my neighbor has a gaming setup for Formula One driving, and it's got like a heavy steering wheel, and it's got screens all around. I love it. So I really want that. But I love gaming. My biggest problem is I don't have the time, and if I had the time, my wife would find that time and make me do something else with her. So I love the idea, and I certainly I do think that he's absolutely right about the future. I worry though about some of the applications that it could go.
Yeah, me too. Two thoughts. One of the things that I think that makes Alexander's thinking on this subject so interesting is that his key insight is that gaming is going to be an operating system that connects the world. We've already built these very rich worlds. We've built the technology, we've built the hardware, we've built the software, and this is going to be something that's going to expand much more broadly than just in the gaming space per se. And second thought to your Formula One point, I went and did one of those virtual headset Formula One driving games. I sat in the car, get in it. The first thing you're like, wow, this is so amazing. This is so cool. You hit the gas pedal, and the first time you crash that damned virtual car, it's terrifying. It's like your nervous system really believes what's happening in the goggles is happening in the real world. It's just extraordinary how lifelike it is when you have the cues, the 3D binocular vision, the audio, the feedback on the steering wheel. Man, it's just an overwhelming experience.
Formula One drivers, and actually a lot of race car drivers, they all have these gaming setups, and before they go to a new track, they're testing in their simulators, and it's really, really accurate. And you can change the rear wing, you can change the tire settings, you can do anything, and it really is. It shows up in the feedback and the timing, which is incredible. So yeah, I'd really like to have one of those, and I really just need the time. I'll sit here in my office all day.
Tommy, let's go in and grab some questions because they're coming in fast and thick. Here's a question that came to us from YouTube. This is from RAR Capital Concepts. And the question is, and it's a question I'd really like to hear the answer to as well. Thomas, are there signals besides DeMark that you use to think about inflection points / regime shifts? What makes a potential indicator better or worse? He's asking, how do you look at the world if you use other than DeMark, and how do you evaluate indicators for their relevance to your strategy?
Well, I use a lot of different indicators, and I'm not. Well, let's just say one indicator that I use. It's actually a research product from Erlanger, Phil Erlanger. He used to be the head technician at Fidelity, and he's put together just an incredible platform. And he looks at short interest, and I love looking at short interest. And short interest hasn't been as effective this last year because I think what's been more effective is looking at put calls and the ratio of put buying versus call buying. And I found, and it's been uncanny how well it works when there's high amounts of call buying, and usually the stocks have already moved higher. It's a good signal that it could fade. It just gives you a good positioning. And if there's a lot of put buying, there's a good chance that you might get a put squeeze, which is sort of like a short squeeze. And I just did this with Nike recently. There was a lot of call buying at the highs. I shorted it the day before earnings. I looked at it and put it out onto my research, and I said, look, there's a lot of put buying now. I covered it, and the stock went up, and there was a put squeeze. So I love looking at that. And one other thing that I like, as far as with the DeMark indicators, I like to look at time periods that go in sync. And like I talked about the bond market that's in sync. So you have the daily, weekly, and monthly, and I tend to focus on, I look at 60-minute timeframes for tactical trading, and then daily, and then an overall longer-term picture with the weekly. The monthly is sort of interesting, but it's not as obviously as timely, but it gives you an understanding. But that's kind of what I look at.
Yeah. Since you mentioned Erlinger research, I'd like to mention another research note, hedge fund telemetry, your research note that you put out daily. Today's message, mixed messages. I thought, great quote here, talking of Erlinger research. Quote, last year in the total universe that Erlinger research follows showed only 55% of all stocks were up in 2021. Obviously, a banner year for the broader equity markets. This speaks to the point about the concentration of the gains and the narrowness of the market.
Yeah, we've seen that for, I mean, it was a little bit more, the dispersion was a little higher this year and this last year, and there were really some great opportunities for shorting. And I've mentioned some ideas in the past and on Real Vision, and they really worked well. And you just have to almost find the ones that people aren't really looking at. And I don't like to find the ones that, well, I did with Tesla, but that's, but the stuff that's not really being focused on. And like Nike is one that people weren't really looking at it, and it fell back, and I made, 8% on the downside, which for a short in this type of market, I'm fine doing that. DoorDash was another one. I did a pair trade with FedEx. FedEx is a long and DoorDash is a short, and it was a 40% combined win. It's there's ideas out there. Yeah.
So, Tom, as we come to the close of this show, curious, final thoughts, key takeaways that you'd like to leave folks with.
Well, I think that right now is a tricky time. We're heading into earnings, and if the market sells off into earnings, I think that actually sets up better for bulls, because if things get a little bit more oversold, the bar goes down a bit for earnings, and stocks can bounce from there. And I think also there's going to be more put buying happening, and I'll tweet out some of the Erlinger stuff that will show the heavy put buying. And in March of 2020, which there's a lot of signals as far as the amount of selling going on right now at the brokerages, there was a huge put buying at the lows. And I just looked at this and said, this market's going to rip. And I think that could happen again. I think this is going to be a year of tactical trading. It's not one you just, I'm going to buy the S&P and sit back and do nothing. I think it's going to be tough. And I think it's going to take a lot of diligence and tactical trading, basically, and finding a lot of good ideas. There's going to be ups and downs, much more than the 4% down move that we had, I think, 3 times last year.
Yeah, Tommy, that sounds like a setup for a really interesting year. You and I have to keep doing this, do it more often. This was a lot of fun, man.
Yeah, thanks for having me, and welcome back.
Thank you. And thanks again for watching Real Vision Daily Briefing. Maggie Lake will be back tomorrow with Peter Bookvar. As always, the conversation continues on Real Vision's Exchange. Thanks for watching, everybody.